Hey everyone, welcome back to my channel. Today we're diving into ASC 815, the accounting standard that deals with derivatives and hedging. Now, if you've ever heard the word derivative and immediately thought I have no clue what that means, don't worry, you're not alone. I'm here to break it down in super simple terms, and I'll even throw in some real-world examples to help you understand it better. So let's get started. Alright, so what is ASC 815 all about? ASC 815 is the part of the accounting standards codification that provides guidance on derivatives and hedging activities. But before we get into the accounting side, let's break down the two major terms here, derivatives and hedging, because understanding these two is key. A derivative is simply a financial contract that gets its value from something else, like a stock price, interest rate, or foreign currency. Think of it like this. Let's say you and I make a bet. I bet you $100 that Apple's stock price will go up next month. This bet is not based on a physical product. It's based on the future outcome of something else. That's essentially what a derivative is. Derivatives can come in many forms like futures contracts, commonly used in commodities. Options contracts, buying or selling stocks at a future price. Swaps, like swapping interest rates or currencies. The key takeaway here is, the value of a derivative is always linked to something else. Now you might be wondering, why do companies even use derivatives? Great question. Companies use derivatives to manage risk. Imagine you run a large coffee company that buys coffee beans from overseas. If the US dollar suddenly weakens, your coffee beans might become a lot more expensive. So to protect yourself, you can enter into a derivative contract that locks in the exchange rate today for a future date. That way, even if the dollar weakens, you're protected. This act of reducing risk is called hedging, and that brings us to the second part of ASC 815, hedging. What is hedging? Hedging is basically like buying insurance for your finances. It's a way for companies to protect themselves from unexpected losses due to things like interest rate changes, foreign currency fluctuations, and commodity price changes. Here's a quick example. Let's say you own a company that sells chocolate. You know cocoa prices go up and down. If you don't do anything, and cocoa prices skyrocket, you'll lose a lot of money. But if you enter into a futures contract to lock in the cocoa price today, even if prices go up in the future, you're protected. This is a classic example of hedging. How does ASC 815 handle derivatives? Alright, now let's get into the accounting part. According to ASC 815, if a company uses a derivative, they have to do two main things. 1. Record the derivative on the balance sheet. You can't just ignore it. Every derivative must be recorded as either an asset or a liability on the balance sheet, depending on whether it's making you money or losing you money. Record changes in value. Every time the value of the derivative changes, you have to recognize that change in your income statement, unless you qualify for hedge accounting, which we'll get to in a second. What is hedge accounting and why it's helpful? Hedge accounting is like a special rule that helps smooth out the crazy ups and downs of derivative gains and losses. Normally, if the value of your derivative goes up or down, you'd have to report that in your income statement, which could make your profits look super volatile. Hedge accounting allows you to offset those gains and losses by matching them with the gains or losses of the thing you're hedging. For example, if you're hedging against rising cocoa prices and the price goes up, you might lose money on the derivative, but save money on your cocoa purchase. With hedge accounting, those two changes offset each other on the financial statements, making things look a lot smoother. Under ASC 815, there are three main types of hedges. Let me break these down quickly. 1. Fair value hedge. This protects against changes in the fair value of an asset or liability. Example, you issue fixed-rate debt, but you're worried interest rates will go down. So you use an interest rate swap to change it to a floating rate. 2. Cash flow hedge. This protects against variability in future cash flows. Example, you expect to buy cocoa in 6 months, so you lock in today's price to avoid future price spikes. 3. Net investment hedge. This is used when you have investments in foreign subsidiaries, and you want to protect against foreign currency fluctuations. Example, you own a business in Europe, but the euro to dollar exchange rate fluctuates, so you use a hedge to protect your investment's value. Alright, here's a super simplified version of how the journal entries work. Here is the journal entry when you enter a derivative contract. Here is the journal entry when the derivative gains or loses value. When the derivative is settled, the asset or liability is removed, and cash is recorded. Here is the journal entry when you realize a gain or loss upon settlement. And that's a wrap on ASC 815, Derivatives and Hedging. Here's the key takeaway. Derivatives get their value from something else. Hedging is a way to protect against financial risk. ASC 815 tells companies how to account for these derivatives, and, if they qualify, use hedge accounting to smooth out the gains and losses. If you enjoyed this video, don't forget to hit that like button and subscribe for more easy-to-understand accounting content.